What do you make of the data?
Well, morning, Guy. I mean, I think that the French inflation speaks to the ECB's problem. You saw inflation ticking modestly higher, even in an economy that has been beset with prolonged political uncertainty. Yesterday, we saw German numbers tick higher, much higher than a forecast as well. So that speaks to the euro area inflation that is due later today, that is going to be ticking a lot higher. So what does all this mean? All this means that one of the most mispriced corners of the markets at the start of 2025 has to be the ECB's trajectory and its reaction function. Traders reckon that the ECB will cut rates so deep as to take its deposit rate well below 2%. I think they are barking up the wrong tree here. The Taylor rule, which is the holy grail of central bank policy making, suggests that the ECB's neutral rate is somewhere between 230 and 250. If you ask the ECB speakers, they are suggesting a range between 2 and 250. So even if you take 2 and 250 at their word, the markets are essentially saying that the ECB is going to take its rate well below neutral territory. That is not happening. If you look at gas prices across Europe, if you look at inflation prints that are coming out of Europe, that's not happening. What the markets are fearing is that the ECB will have to cut rates really deep below neutral if Trump levies the tariffs, which is possible, but it is not my base case, which is why that is especially so in a world where the Fed is nearly on hold. The ECB isn't on autopilot and isn't about to take its rate well below neutral unless the economy falls into an abyss, which I don't think is the case.
And meanwhile, then, we've been talking about the threat to Rachel Reeves from the bond vigilantes, the 30-year gilt yield up at Gordon Brown as Chancellor levels 25 years ago. But the BOE, if we can talk about that, why are the markets factoring in just 2 rate cuts from the BOE?
The markets have very good reason to be skeptical of the BOE, Lizzy. Just look at what is happening to the inflation break-even rates there. The 2-year rate has shot up by, 50 basis points since the government's autumn budget. That rate estimates that inflation will be something like 3.6% over the next couple of years. So the question before the BOE really is, where should your benchmark rate be if inflation is approaching 4%? As you know, the BOE rate is already at 4.75. So the room for the central bank to cut rates willy-nilly in that scenario is rather limited. And that is why, if you look at gilt yields, 2-year gilt yields, they found an equilibrium around 442, and that is the level they are going to find it very hard to shake off until and unless inflation comes down.